Just when the market thought the economy might be slowing, the jobs report came in stronger than expected. Hiring remains solid, and the labor market continues showing surprising resilience. At the same time, the housing market continues to remind us why real estate has been one of the most reliable wealth building tools over the long run, even with higher mortgage rates and affordability challenges. Good afternoon. Last week brought another round of market volatility as investors digested a full slate of economic data while continuing to keep a close eye on the developments in the Middle East. To start the week, the 10-year Treasury climbed back to 4.57%, putting renewed pressure on mortgage rates as investors continue trying to gauge the inflation outlook. Adding to the anticipation, we'll be getting fresh readings on both consumer and wholesale inflation this week, which always has the potential to create significant movement in the bond market and with mortgage rates. Meanwhile, oil prices continue hovering around $90 per barrel, leaving investors cautiously waiting for more clarity on how geopolitical tensions and higher energy costs could impact inflation moving forward. The challenge for the market right now is that nobody knows exactly how much of this inflation pressure will be temporary versus long lasting. That's why investors remain so focused on inflation data and the bond market. As a reminder, mortgage rates tend to follow inflation expectations very closely. If you're ever wondering why rates are moving, keep an eye on the 10-year Treasury and ask yourself one simple question. Is the market seeing more or less inflationary pressure? More often than not, that's the story driving mortgage rates. With that being said, let's dive into what took place last week. Here are your headlines. The latest Bureau of Labor Statistics report showed stronger than expected job growth in May. The economy added 172,000 jobs compared with forecasts of about 85,000. Job gains from March and April were also revised higher by a combined 93,000 jobs. The unemployment rate held steady at 4.3%. At first glance, the job report was another positive sign for the economy. Job growth averaged 188,000 new jobs per month over the last 3 months, which is a healthy pace and reinforces the idea that the labor market remains fairly resilient. That said, when you dig a little deeper into the report, there are still some signs that all may not be as strong as the headline number suggests. Full-time employment actually declined by 79,000 jobs, while part-time employment increased by 266,000. We also saw long-term unemployment rise to its highest level since 2021, which tells me that while companies are still hiring, people who lose their jobs may be having a harder time finding new ones. The takeaway here is that the labor market continues holding up better than many expected, but there are still enough cracks beneath the surface to keep investors debating whether the economy is truly re-accelerating or simply slowing at a much more gradual pace. Now, private payroll data from ADP offered a similar signal to the government jobs report. Employers added 122,000 jobs in May, just above forecasts. Hiring was spread across all businesses of all sizes, with small businesses leading the gains, and 8 of 10 major sectors posting job growth. The takeaway here is that the labor market remains healthy overall, but we're continuing to see the signs that things are gradually normalizing rather than accelerating. Hiring appears to be broadening across multiple sectors, which is generally a positive sign as we head into the summer months. We're also seeing some improvement in the overall pace of hiring. Over the last 3 months, job growth has averaged about 96,000 jobs per month, which is a noticeable improvement from the 67,000 average that we have seen over the last 6 months. That said, much of the hiring continues to come from education and health services, which tend to be more stable industries and aren't always the best indicator of what's happening across the broader economy. One area I'm keeping an eye on is wages. People who switch jobs continue to see larger pay increases than those who stayed put, but that gap continues to narrow. To me, that's another sign that the labor market may not be quite as competitive as it was a couple years ago when employers were aggressively competing for workers. Now, in housing news, home prices rose 0.4% from March to April and were up 0.3% higher than a year ago, according to Cotality's latest Home Price Insights report. Cotality also recently increased its forecast and now expects home prices to rise 5.3% over the next year, which is slightly higher than its previous projection. To me, this is another reminder of why I continue talking about real estate as a long-term wealth building tool. A lot of buyers get caught up trying to time interest rates perfectly, but they sometimes overlook the fact that home values can continue appreciating while they're waiting on the sidelines. For perspective, a $500,000 home appreciating by 5% would gain roughly $25,000 in value over the course of a year. Now, that's not guaranteed, of course, but it does highlight how consistent appreciation can create meaningful wealth over time for homeowners. As we move into another important week for the markets, all eyes will be on inflation and housing. We'll get the latest existing home sales report this morning, followed by two of the most closely watched inflation reports of the month: the Consumer Price Index, or CPI, on Wednesday, and the Producer Price Index, or PPI, on Thursday. We'll also receive the latest jobless claims data on Thursday, giving investors another look at the health of the labor market. We'll have to see what the numbers tell us, but for now, have a great rest of your week. And as always, feel free to reach out if you have any questions about the market, mortgage rates, or your home financing goals. Have a great rest of your day.